the governor of the Central Bank of Iraq, Ali Mohsen al-Alak, welcomed a delegation from the Islamic Corporation for the Insurance of Investment and Export Credit, ICIC, a member of the Islamic Development Bank Group. Talk centered on strengthening bilateral cooperation and reviewing a study on loan insurance for foreign and investment companies, designed to support financing for major strategic projects with the Iraqi government. The recent meeting between the governor of the Central Bank of Iraq, CBI, Ali Mohsen al-Alak, and a delegation from the Islamic Corporation for the Insurance of Investment and Export Credit, ICIC, marks a significant development in Iraq's ongoing efforts to stabilize its economy, attract foreign capital, and position itself as a serious player in regional and global markets. The topics discussed: loan insurance, foreign investment, and financing strategic projects are not isolated matters of economic cooperation. They directly tie into Iraq's larger monetary trajectory, including the long-debated possibility of an Iraqi Dinar Revaluation, IQDRV. To understand how this meeting relates to the dinar revaluation, one must look at Iraq's financial strategy, its foreign investment framework, and the mechanics of currency valuation in a globalized economy. 1. The role of ICIC and why it matters. The ICEIC, as part of the Islamic Development Bank Group, specializes in providing risk insurance for cross-border trade, investment, and financing for foreign companies hesitant about entering volatile markets like Iraq. ICIC guarantees help mitigate risks associated with political instability, payment defaults, or project uncertainties. By welcoming ICEIC's study on loan insurance for foreign and investment companies, Iraq is signaling three things. 1. A commitment to protect investors. Insurance reduces perceived risk, meaning that international companies can commit to large projects in Iraq without fearing sudden losses. 2. Readiness to launch strategic projects. Iraq's major projects in energy, infrastructure, housing, and digital transformation require billions in financing, which cannot materialize without investor confidence. 3. Strengthening development partnerships. Cooperation with ICEIC aligns Iraq with Islamic finance principles, which is attractive to Gulf investors, Middle Eastern funds, and international development partners. 2. Investment confidence and the dinar. The IQD has historically suffered from instability due to wars, sanctions, and governance issues. For a currency to gain strength or undergo a revaluation, international confidence is essential. Foreign investors must believe that their money is safe, repatriable, and convertible at fair exchange rates. ICEIC's involvement is essentially a stamp of approval from a major international Islamic financial institution. Concerning the parallel market, and since you cited the 2024 Art4 consultations, the report below suggests they are near match stage. Saleh's words. You have to wonder though why it really matters. That market is nearly dead. The 2025 IMF consultations focuses on absorbing the excess liquidity and improving monetary policy transmission. The IMF's 2025 Article 4 consultation with Iraq does indeed mention liquidity sterilization, and it's a strategically loaded term in this context. Liquidity sterilization refers to central bank operations that neutralize or offset the impact of liquidity injections. However, what about excess liquidity of currency stored outside the banking system? The issue of excess currency liquidity stored outside the banking system is one of Iraq's most stubborn monetary transmission bottlenecks, and it directly undermines the effectiveness of sterilization. The IMF keys on this subject, and I'm certain this dead liquidity is the focus of the IMF. After all, it is immune from the effects of monetary policy. Only bringing that currency into the banking system solves the issue. No one can deny the CBI's monumental efforts to engage the population. Every standard monetary tool has been employed, yet 80% of cash still remains outside the system, necessitating radical and urgent reform as cited just today by Ahmed Al-Tamimi. It's going to require the forced introduction of lower banknotes to draw that stored money into the banking system. That is the only way the CBI can improve monetary policy transmission. The IMF seems to be signaling the next move. Through 5 factors. Iraq aims to reach the dollar price to the match stage. The 22nd of July 2025. 12:34 Sharefont. Shafaq News. Baghdad. The financial and economic advisor to Prime Minister Mohammed Shia al-Sudani revealed on Tuesday 5 factors that lead to reducing the gap between the official rate of the dollar and its price in the parallel market, in a path that may lead to reaching the stage of congruence between the two prices. The official dollar exchange rate approved by the Central Bank of Iraq is 132,000 dinars per $100, while exchange rates in the parallel market over the past 2 days approached 139,000 dinars in Baghdad and the Kurdistan region, which represents a gap that the government seeks to reduce. Mizom Mohammed Saleh told Shafaq News agency that the decline in the value of the dollar in the parallel market in favor of the Iraqi dinar and its approach to the official rate is due to several reasons and factors, the first of which is preventing dealing with the dollar internally, especially in the real estate sector, which constituted a basic deterrent to the phenomenon of dollarization. SOB restructuring, better corporate governance, stronger supervision, and critical enablers like a credit bureau and a beefed-up deposit insurance scheme. The same report also notes that since January 2025, commercial banks, not the central bank, have handled trade finance through their CBRs, with the CBI auditing flows post factum for AML-SCFT compliance, a change the IMF directly links to the reduced official parallel spread and rising formal sector usage. Put differently, the IMF is telling you that the official value of the dinar and the effective street value only converge sustainably when banks, not cash windows, intermediate trade and payments in a system that global correspondents trust. That's the precondition for any stable currency regime. And it's why this reform package is so relevant to RV chatter. On the nuts and bolts inside the SOBs, the IMF highlights how undercapitalization from legacy assets, weak risk management, and poor governance at the two giants, Rafadain and Rashid, have long blocked private bank development and hampered credit markets. The authorities plan spinning assets into a Rafadain first entity with minority state ownership, refocusing legacy Rafadain on government accounts, and merging Al-Rashid still needs clarity on asset or liability transfers, NPL resolution, and recap sources. But it's directionally aimed at breaking that logjam. Why does that matter for the dinar? Because until the big SOBs stop functioning as quasi-fiscal appendages with opaque books and start operating on commercial, audited, core banking rails, a huge chunk of dinar liquidity sits inert or misallocated. Monetary signals don't pass through to deposit or lending rates, and households and firms hedge in dollars, behavior that weakens demand for dinar assets and keeps pressure on the FX market regardless of what you print on an official rate board. Conversely, successful restructuring, backed by modern core banking systems, real governance bylaws, and a clear ownership policy that limits political interference, expands dinar-denominated credit to the private sector, deepens local assets on the ISX, and raises the opportunity cost of hoarding dollars, all of which support the dinar's effective value over time, even if the nominal peg stays where it is. The IMF is explicit about several of these pillars. It urges issuance of short-term CBI bills to mop up liquidity, so the policy rate bites. It praises the shift to CBR-based trade finance for reducing the unofficial spread. It calls for SOB governance bylaws, robust supervision and regulation, an ownership policy that defines the state's role, and fast-tracked adoption of modern core banking systems. Those prescriptions go straight at the drivers of Iraq's parallel market, premium, compliance frictions, informality, and excess dinar liquidity. In fact, the IMF puts numbers around the macro frame. It projects the exchange rate at 1,300 IQD per USD through 2026,